You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. All right, we are in the heart of earnings season, and I should let you know that we are taping. The market is open. It's 3:30 p.m. Eastern Time on Wednesday, the 18th. We're going to be looking at a trade. I'm going to try to change it up a little bit here. Next week, we have a lot of the FANGs that are going to be coming out with earnings next week. One of them is Google. Google is going to be one of the quickest ones to come on out and announce. Google will be announcing earnings on Monday, the 23rd, after the close. So, as with always on Options Playbook Radio, we're always just trying to look at unique situations and unique option strategies. And I haven't yet, I don't think on Options Playbook Radio, looked at a diagonal around the big stocks like Google, Amazon, all the FANG stocks in general. So I'm going to look at using the diagonal because there's so much premium in the Google underlying to try to have a low cost call going into Google earnings. So a lot of times we look at strategies that expire after their earnings. We're going to actually use one expiration that's actually before their earnings. So we're going to try to put this trade together. We're going to sell a near-term option that will pay for a further out option contract. All right. So with that said, let's get right into the trade. So Google right now is currently, I just took a screenshot, it's trading at $1,215.61. It's up $2.53 on the day. We're going to go out and sell the nearest expiration. We do know that Google is going to be announcing earnings on the 23rd. So we're going to sell something that expires on Friday the 20th and buy something that expires on Friday the 27th. So these are the expirations that we're going to be working with. And we're trying to get this trade done for a net credit to the account. So if I do this trade, there is going to be a little bit of a hefty requirement on the trade, but we really hope by the first expiration date, the risk, the ultimate risk of the trade isn't nearly as great as the width of the spreads. So I'll set up the trade. We'll talk about the exact cost of the trade, and then we'll just look at the risk of the trade overall, according to the Ally Invest profit and loss calculator. So we are going to sell one July 20th expiration, 12:30 call, and we're going to buy one July 27th expiration, 13:20 call. So the 13:20 call minus the 1230 call is actually a 90-point credit spread. So it's a $9,000 requirement to do this trade one by one. Now, what are we really looking to happen with this trade? If I look at Google and I look at what the expected move is in Google right now, we'll see that on the near-term expiration in Google, the one that we are selling, the option contract that we are selling, that expected move is about 15 points. So we're selling something based off of where the market is at right now that is 15 points away from the current stock price. All right. So our goal here is to hope by the Friday expiration, remember it's Wednesday, the market's about to close, so you got 2 full trading days, that the market, that Google does not go up 15 points. We do not want it to go up 15 points. If it goes up 15 points, we're getting out of this trade. We're just heading for the hills. Our biggest risk here is a big gap opening or that, but we have earnings next week. We don't have it on the near term. So we have risk to start with, but if we do get to 1320, we're just going to get out of the trade. And if I did this entire trade, and I can actually do it for a net credit to the account, the net credit to the account would be 15 cents. So if the market went straight down before that first expiration date, I would make 15 cents on this trade. I'd be long a call option all the way out to the 27th expiration, but I'm bringing in a small credit of 15 cents. Now, if the market started moving towards our short strike, the 1230 strike, since we are short delta, and it's going to, on the position basis, for every 1 point move, we're going to lose approximately, let's call it $15 to make it simple. We ultimately want that market to go that way, but it can cost us money in the short term, at least on our profit and loss inside our account. But our ideal scenario would be that the market went to 1229, 1 point shy of 1230, our short strike, and that near-term option expired worthless, and basically we'd be long a call going into earnings at a 15-cent credit because the short-term option paid for our longer-term call option. All right. So the first expected move is by the July 20th expiration is just a 15-point move. If we go out and look at the expected move after the earnings, looking at the July 27th expiration, that expected move is about 60 points. So if we can position ourselves, so we have a long shot. So the market right now is at 1215. Our long strike with the July 27th expiration is 1320. We're looking at about a 100-point move in Google, which is more than the expected move, but we're hoping to be into this trade for a net credit to the account of 15 cents. So we have a fairly big margin requirement, but if I look at the Trade King profit and loss graph and the market goes, we put the trade on and it instantly runs the 15 points up to the 1230 level, this position, without any changes to implied volatility or anything, would have a loss of $350 for every one by one that we did. So that's kind of where we've got to plan our risk out. Obviously, the worst case scenario can always happen. But in this scenario, if volatility stay where they're at, the market goes straight to 1230, I'm going to get out of the trade. I'm just going to close out the position. We're going to be done. I'm going to take my smaller loss and say, well, I guess I was wrong, and just move into my earnings play on Google or whatever else I would like to do with the underlying. So this is a very interesting trade in that we are trying to take advantage of the fact that the short-term option contract still has a lot of juice in it, relative to the longer term contract, just because of the way that Google trades. And we're just hoping that with that expiration, if we get a big pop up, we might see, even though volatilities would come off on that underlying, we might have a potential, if Google skyrockets, to get into a call for a net credit of 15 cents to the account. So let's go back and recap. We are looking to do a diagonal spread in Google. It's going to be a very short-term trade. We're going to sell the nearest term expiration, which is the July 20th expiration, 12/30 call option. And then we're going to go out and use those proceeds to pay for the July 27th expiration. And we're going to buy a 13/20 strike call. We're going to do this for a net credit of 15 cents to the account. If we are dead wrong and the market goes down, we're going to make 15 cents on the trade, even though we're ultimately bullish. The market moves against us fast. We're going to get out. If the market hits 12/30, our short strike, we're going to just not even look at the market. We're just going to try to get out of the trade. Potential move, if that happens, would we be down between $350 to $400 for every 1x2 that we did. The margin requirement on the account, though, is large. It's $9,000 in this underlying if we ended up doing this trade. But we're going to manage our risk before we get into it. So call up in a couple of days, and by Friday we'll know where Google ended up at, and we'll see if we are long a call going into that expiration date. So that's it for this episode of Options Playbook Radio. If you have a topic you'd like us to discuss on the show, question you'd like us to answer on the program, you can send them directly to me at theoptionsguy@invest.ally.com. That's theoptionsguy@invest.ally.com. Thanks for listening. We'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.